All right, so we got one paper down. The average on this paper tends to be a little high because the average on exams tend to be kind of low, but I don't think this class will break the trend and do well on both. So if you have an interview, I'm just giving you something you can talk about. That y'all check out the last JAWS report since this one. Hopefully I'm getting you hooked. I mean, this is what you're going to do the rest of your life. These JAWS reports are pretty important. So jobs Fredericksburg. I didn't want me to do that. So, I would keep track of these. You want to do the change monthly. It's hard to see it because of COVID, right? So, but you can still see it by just changing it to 1 year. So what has jobless claims done here recently? If I were you for a job interview, I would be going out these major things. One thing that's really good to have is, so I showed the Investor Society my dashboard for markets, what's expensive, what's cheap, what a market's been doing. I would have the same thing with economic data. Just have a Bloomberg screen you update maybe every Monday or something, so you just know what's going on. So when you go into an interview, you have a good idea. What's the LAI doing? What was GDP last quarter? What's the employment, extremely important one? What's inflation? What's the PMI? Those kind of things are really, really critical that you just know. Some of those, like PMI, people don't always pay attention to that until it's really important, and they do. So knowing it, they may not know it. So if you throw out something they haven't been paying attention to, that's even more impressive. But you can see how the Fred makes it so easy. Again, you have to take out COVID because you can't see anything without COVID. So that looks like a good trend, doesn't it? They can do the 4-week moving average. The LEI, I think, is really, really good to do. That one hasn't been so great. Well, I guess recently it has done well. I don't know why it would have jumped up here recently. Maybe because the stock market came back. The yield curve is still inverted. But having a good sense of what's going on in markets. So the paper you just did is that kind of paper. Not just what was the employment report, but how did the markets react, where interest rates, those kind of things are pretty critical to know. The second paper is a little bit different. I don't give you an example paper of this one. I might show you some in class. The reason I don't give an example paper here is I don't want you to copy that format. So many students on paper one did what I said not to do, which is the JOBS report, the stock market, and then the PMI. That makes no sense to me at all. But why did I do that? Because the example paper I gave did that. But it just doesn't make sense to me. Why are you jumping between markets and economics? But I need to take that example paper out so students stop doing that. But it's just not logical. So I want you to come up with your own format. So this is, to me, the most fun paper. I really love this one. It's an earnings announcement paper. Pretty common that you would do this. So you're working for a firm and they have a portfolio. Hey, so-and-so's earnings coming out next week or today. I need a report at the end of the day. And my end of the day is like a month from now. So I'm giving you a lot more time you get in practice. But you got a portfolio manager who's pretty busy. They can't follow all of their stocks. So they need you to do this. Now, if you work for a trade desk, which I highly recommend if you can get a job on a trade desk, this is what they do. They come in at 4 or 5 o'clock in the morning, and they're making sure they know everything that's going on in the portfolio. So if there's any news anywhere, so they may not write a paper, but first thing in the morning, everybody gathers around the trading desk. And the trading desk, like, man, you got to watch this bond. They just had an announcement yesterday. This stock, you got to watch out. Their earnings coming out before open today. People are expecting whatever. They make sure everybody knows what's going on in the portfolio. That's why the trade desk is such a great place to work, because you got to know everything. It's a tough place to work. Boy, it's high stress. Bunch of people cussing all day. They're kind of high-strung people that look like they're about to have a heart attack at any second. It's a tough job. You wouldn't want to work your whole career there, but you do learn a lot doing that. And so this is what we're going to do, firm's earnings. Similar to what you did in paper one. What did they report versus what was expected? And then what was the prior number? You see how that's a really big trend. What's the number? What was expected? What was it last year? So you can do the same thing here. You might talk about some adjustments, and we'll talk a little bit about that. Depends on the company. And then you're going to do the exact same thing, but with revenue. So it's kind of like the jobs report, except for here, instead of jobs and unemployment rate, here it's going to be earnings and revenues. So you're going to talk about that. What were the revenues? What was expected? What was it last time? The exact same type of analysis. And then you're going to look at the bottom line. There's a couple of margins you can look at. It depends on your company, but the gross margin and net margin. Right now, these are really, really important numbers. If you're looking at firms like Kellogg's or Pepsi, with inflation, the question people are asking, if their cost of goods sold is up 10%, are they raising their prices 10%? Or are their margins getting squeezed? Y'all know what margins getting squeezed means, right? That anytime you see the word margin, what's your denominator? Margin, you always divide by revenues. So you're looking at your profitability versus your revenue. And so if inflation's up 10%, but you only raise your prices 5%, your margins are going to come down because you're having to eat some of that inflation. So some firms, like we were looking at Pepsi earlier, it's like, wow, they have really good revenue growth. Well, but their cost of goods sold are also up quite a bit. If you're doing Kellogg's, are their cost of goods sold up? Did Putin help cut Kellogg's at all? I mean, you're buying a lot of grain, right? So you want to know how much of that are they passing on to their customers and how much is it killing their margins. So this is a pretty important part. And then how did the market react? And I'll talk about a few places you can add here. Obviously, how did the stock of your company react? But then you probably want to also compare that to the S&P, because let's say your company stock was down 1%. You say, well, that's bad. But the S&P was down 3%. Well, maybe down 1% isn't all that bad if the market's down 3%. Or maybe your stock was up 1%, but the market was up 2%. Or maybe your stock was up 1% and the market was down 3%. You know, who knows? It can be all over the place. So you're trying to figure that out. But not only that, if I was looking at Home Depot stock and it was down 2%, what other stock might I throw into my analysis? You think of any that you want to compare that to?
Lowe's.
Yeah, Lowe's. Wouldn't that be the obvious thing? Hey, Home Depot is up 2%, but Lowe's is down 3%. That would be unusual. I've seen that with CVS and Walgreens, where one will be up and the other's down. You're like, okay, that's interesting. Why do they react so positively to one and the other was down? Kenny?
I don't think there's such thing as Builder Square anymore. Right?
Oh, I don't know if they exist. I don't think I've ever been in one before. And if you stuck me in the middle of a Lowe's and a Home Depot, I wouldn't know which one I was in without looking at brand names. All right, so there's a lot of things you can do here. You want to talk about the stock on that day, but I think your boss would also be curious, how's the stock done year to date? Maybe how it's done since COVID. You know, there's certain things. Some of the stuff's kind of old. Home Depot's been a really. I probably can't do Home Depot because it won't report earnings during this time. But that would have, in fact, I'm always looking. I'm going to give y'all a file of stocks you can select from, and I'm hoping to find some really good ones. But we've had some really good stocks here recently. Meta was the obvious one, but Home Depot, Walgreens, we've had some really interesting ones here recently. So I'm hoping for some exciting one. What is exciting is the main thing is I report something that's a little surprising. The stock moves a bunch. So that's the real thing. I don't want. They expected $2 per share. They got $2 per share, and the stock was up 0.1%. That's a boring paper. So I'm looking for a stock that does something crazy. And sometimes the craziest things is they beat and the stock's down 10%. That's the interesting one. The market was expecting $2. They got $2.10 and the stock's down 10%. What in the world is going on? That gives you something really, really interesting to write about. One thing we've learned in some markets is they'll beat on earnings and miss on revenue, and the stock will just crater. And those are interesting ones. So it kind of depends on what's going on in the company. So I'm going to be looking for something that's interesting, a big news, something major happened and the stock market moved dramatically. My favorite ones is when they report good news and the stock comes down. I think that's the most interesting because you're like, okay, what is the market seeing? That's not obvious in the numbers. What's management saying? What are analysts saying? Journalists? To me, journalists are my least favorite because a lot of them they're not finance people, they're not investors, they're journalists. So I like it when management or analysts are saying things. Bloomberg is a great source for this. If you go to Bloomberg machine and type in that company for the day of their earnings, you'll see news articles, you'll see videos that you can watch and that talk about the company. And then your final conclusion, did the stock market reaction make sense given what we saw? Yes or no? If they beat earnings by 2%, but the stock's up 10%, you're like, okay, what's going on here? There's obviously some companies people are very, very focused on right now. You take a firm like Disney with a new CEO and all kinds of things going on. That's pretty important. Netflix is obviously very, very important. I mean, it's possible Disney reports good numbers and Netflix goes down because the two of them are essentially battling each other. So it's a fun paper. There's a lot to do there. This is the file I'll create. This is the one I did last semester, so y'all won't have this one. But I'll give you a bunch of companies. If there's one you're interested in, let me know. But it has to have those two characteristics. It had to have reported earnings sometime last week in the next few weeks, sometime in March, and it had to be interesting. So those are the two things I'm looking for. So you can see the companies I did before. FedEx missed by 31%. The market was expecting $5. They reported $3.44. They were 21% behind last year. They missed on revenues, but they were above last year. How in the world can you beat on earnings beat on revenue and have revenues higher and earnings lower? Well, what cost did FedEx have this last year that might have harmed their earnings? Maybe gasoline, right? But gas prices up a bunch. So gross margin, you notice I don't do the percentage change in gross margin, I do basis points. And why is that? Because gross margin is a what? It's a percent. Anytime you talk about a percent. Some of y'all did really well on this first paper and talking about differences in percents as far as changes in basis points. And then their EBITDA margin. So gross margin is their revenues minus cost of goods sold. That's where their raw material inflation comes in and their net margin. And then what did the stock price do? Did the stock market like it? Does that look like a good reaction from the stock market? It looks pretty negative. Is that what you'd expect when a firm misses by that much? Yeah, that's what you'd expect. So the stock was down dramatically. The stock was down 21%, but I put UPS in there. UPS was down 4%. The market was down 0.7%, and industrial stocks were down 2%. You see the things I'm comparing to. So is it pretty obvious the stock market was reacting to this earnings report for FedEx? Pretty obvious, right? They're down 21% on a bad report. So that's what, it makes you right there want to write the paper, doesn't it? If you're a finance major, you're like, wow, this is interesting. I got to figure out why did they miss, what's going on, pretty interesting stuff. We know a lot about FedEx. When I first saw my first Amazon Prime truck I saw, wow, that's interesting. Amazon's delivering door to door. That can't be good for FedEx and UPS. But then I was reading UPS's argument was, who cares? That's our least profitable business. They can have it. So was that really true, or is that their excuse for giving up a big chunk of their business? But that probably is true. That probably is a pretty unprofitable part of their business. I don't know if Amazon's buying planes yet to fly around, but FedEx and UPS have a lot of planes. That's a big part of their business. But there's a lot to talk about there. Netflix, obviously, they beat on earnings, but they were lower than last year. They beat on revenue and are slightly higher, and the stock loved it. But one thing with Netflix is everybody look at that's you're always going to talk about what you think. Would subscribers be important? How many subscribers? What did Netflix do? They're supposedly raised their prices, and they supposedly shut down those multiple accounts. I have no idea if that's true. Is that working? Any guy using your neighbor's accounts and now you can't? So I don't know. I haven't been on Netflix in a while. One thing about Netflix is they make it so easy to cancel. That's a good reason to sign up. It also makes it really easy to cancel. So there's some places that make it so hard to cancel your subscription. So Netflix was interesting last time. United Airlines, obviously coming out of COVID. Constellation Brands was interesting. They beat by quite a bit. Lamb, I don't know anything about Lamb, but they had an interesting report, so I threw it in there. They beat by 49%, and they were up 275% from last time, and the market really loved it. AZZ, I don't know them, but it's interesting. Tesla had a good report. Abbott Labs had a good report, 22%. Alphabet had a horrible report, and their stock dropped quite a bit. Microsoft had a decent report. Their stock dropped. So that was an interesting one, isn't it? Microsoft beat up from last year, beat on revenues up significantly, and their stock dropped. That's an interesting one. What in the world is going on with Microsoft? Why would the stock come down with such a positive report? So hopefully I can find a few of those. Meta, this is during their bad time. Their last report was their good one, but this was last fall where they had their bad report and the stock dropped off the charts. I mean, that's a pretty good drop, isn't it? 25% drop. That's a pretty significant drop. So Verizon, ServiceNow, I don't know what they do, but they had a big hit. So I'm going to try to find you, and you get to pick whichever one you want to do. So I'll give you the numbers. What you have to do is go find the story. All right. However, I strongly recommend you figure out how to get these numbers. So I have a video that shows you how to do it, but I get every single one of these numbers out of Bloomberg. The challenge is these numbers may not be the same numbers that you see in the articles you're reading, especially this. You notice there's two columns. There's reported and there's comp. Anybody know what comp stands for? Which of these numbers does the market care about? But what was actually reported? Let me find one that's different. They're not always different. Okay, here we go. So Constellation Brands, they had $4.65 was what they actually reported. And this term comp, whatever it means, was $3.17. Which of these two numbers does the market look at? Any guesses? 465 is a great number when the market was expecting 280. 317 is kind of okay when the market's expecting 280, but which you may know. Well, the answer is the comp. So what does comp stand for? If the comp is the number everybody's comparing the estimate to, what do you think comp stands for? It means comparable. That's the comparable number. That's the number the market focuses on. That means Constellation had some unusual adjustment that the market's saying, hey, there's a one-time adjustment, never going to happen again. Don't compare that to what the market expectation was. So you'll notice my surprise here is off of the comparable. It's not off of the actual number. What that means, though, is this comparable might be different from another source. All right, so it's possible an article is going to have a different number. The reported number should be the same everywhere. That one shouldn't be any different, but the comparable number can definitely be a different number. So that's the one you have to kind of get used to that. Usually what you'll do, you'll find an article that says Constellation Brands reported $4.65 in earnings, comma, $3.17 after adjusting for. And that just needs to be one sentence in your paper and you don't have to address it anymore. And after that, you only talk about the $3.17. Okay, so there was some adjustment. Sometimes the adjustment is in the gross margin. You can see their gross margins are different. Sometimes it's in EBITDA. You can see their EBITDAs are different. So it just depends on what adjustments they made, who's making that adjustment. So that you have to watch out for. So I'll give you all of this. I give you quite a bit. You just got to come up with the story. So I want you studying the story. But if you want to learn how to do this, every single thing in here, I get off of Bloomberg. So that's my source. If you have other numbers from other sources, it can vary. What I do for finding my companies is you can just do an earnings calendar. I actually like the NASDAQ's the best, but let's see what's out there. The reason I like NASDAQ is they give the market cap. When you look at Yahoo Finance, they don't give the market cap. The market cap's really helpful. Do y'all see anything today? Well, let's see, that's today. Let's find, yes, let's go back to Friday. Any of them stand out? So we're looking at the percentage. So this Kayla Pharmaceuticals, they missed by 21%. So it'll be interesting to see, why did they miss by so much? What did the stock price do? Those are the kind of things that you're looking for. Now, the thing they don't show you here is how the stock reacted. That's a little bit frustrating. That's why I like Bloomberg. Bloomberg, you see what Bloomberg gives you? Gives you the date of the announcement, what quarter it's for, what period it's for. So the date announcement is when it actually reports. What you got to figure out on your paper is, when did they report? Huge importance. Did it report on the 15th before open or after close? If it's before open, then you're going to compare the previous day's close to today's close. If they report after close, the day's close is where you compare tomorrow's close to, because the market doesn't know the earnings today, so it won't be in today's price. So you've got to figure out, that's the one thing I wish they would ask. Did they report before open or after close? Because that's a huge difference between what you can compare. But they also give you what, I didn't put it in here, but they also give you off to the side what the stock did. I'm giving you those charts down here, so you kind of have the advantage that I'm giving you the right days to compare. You have that advantage, but you have to figure that out as well. But unfortunately, NASDAQ doesn't show you the price change. And the other thing is the size of the companies. So I'd like to have the biggest companies on top. So here's a pharmaceutical company. Now, yeah, they had a positive surprise, but they were expecting a loss and they just got a smaller loss. Doesn't sound all that exciting. We go back to a previous day. Broadcom, 4% surprise. Costco, 3% surprise. I think Costco stock fell, didn't it? I can't remember. I remember seeing an article about Costco, but I don't remember what they said. Does it look like an earnings report came in? So it looks like it came in after close on Thursday. The market hated it on Friday and then changed their mind on Monday. But why would Costco beat by 3% and their stock price fall? That's a pretty hefty fall. That's like 2% or so, maybe, or I don't know, 86, 65, so $20. Yeah, I mean, that's a pretty significant fall. They're up today, but yeah, so that would be an interesting report, but it's a little too. I might do Costco. It is in March, so Costco would be an interesting one. Anheuser-Busch, there's an interesting one. They beat by 36%. You think the stock was up? Your assumption would be the stock would be up, wouldn't it? If you beat by 36%, 5 days. Now, how can you tell which day was it? If it was March 1st, 2nd, or 3rd? Is there anything that clues you in to which day you're interested in? The volume, yeah. Earnings day, you're almost always going to the highest volume. So they went from $61 to $62, $1, so about 1.5%, not a huge day up. So why didn't it react more? It was up as much as $62. That's still not that huge, that's about 2%. So why, if you beat by 36%, why is your stock only up 1.5%? So it's, to me, it's really, really interesting stuff to talk about. Excuse me. All right, so I wouldn't worry about this until after the exam, but start thinking about it, start paying attention. This is kind of part of the purpose of this class is you need to convert from a college student into a finance professional. And this is what we do. We watch employment reports, we watch earnings announcements. We're curious about how the market react. You just got to get yourself on habit. And if you find all that boring, then you still have time to change majors and go do something else, because this is what we do. I find it really fascinating stuff. All right. Right, I'm making sure I'm recording. Our class last week, I forgot to hit share. So on that class, you'll just see the screen behind me. So hopefully it's capturing that. But... All right. So we're going to finish up asset strategy execution and get into return calculations, which is a pretty important topic. So there's a few things you can do if you're doing it yourself. Shorting securities is one. I don't highly recommend it, but you can do that. So shorting the securities when you sell a stock that you don't own. And you just think the stock is going to fall in price. You don't want to buy put options because that's expensive. So you want to sell the stock. So maybe you sell it for $100. You hope it'll fall to $80. You buy back for $80 and you got it. You got a big gain. How much can you lose? You can lose infinity. There's no limit, because you buy for 100, hoping it falls to 80, but it goes to 150 or 200 or 300. There's no limit. My advice, never short without a hedge. So if I short a stock, I'm going to buy a call option. I'm going to buy a call option on that stock out of the money. So if I sell a stock for 100, I might buy a call option for 140 or 130 or something, just so I know my max loss on that stock. I don't like unlimited losses. I remember I whiteboarded at UTSA, which is I sat down with the sales force and just listening on calls, and they almost have to shut me up, because there's sometimes like this one person they called, and the lady on the phone, the rep goes, you're short of stock. And she goes, oh, did I short that stock? I forgot about that. I was like, are you crazy? You have a short position that you forgot about? I was like, and the lady was like, he can't be here anymore. He was like, you're not allowed to talk to our customers like that. I was like, how crazy can you be? So how do you actually do this? So there's an entire industry called securities lending that gets this stuff going. They're in a major industry. You might even work in this industry. What they do is they go find this inventory. If you want to sell Apple stock, they go find it, they borrow it, they sell it, they sell somebody else's stock. You got to put up collateral. So they got your collateral. They pay you interest on the collateral. And then they get your collateral, they get to invest it. And then you've got that short. You can buy back. When you buy back, they buy back and put it back in the inventory of the person who had it. The person that you borrow the stock from doesn't ever know that their stock is missing. They got your collateral. Why would they do that? Well, Amazon, other large investors make a lot of money off of securities lending. So, I mean, the way it works is pretty crazy. So you borrow the stock and you put up a margin, maybe 102% of the value of the stock. So that's cash or whatever, you give them cash. They're going to pay you interest on that cash. Maybe they'll pay you 1%. They're going to take that cash you gave them and they're going to go invest it at 1.5%, and they'll make a spread. And that's how Vanguard makes money on securities lending. So they pay you a lot less in interest than you, I mean, they pay you a lot less in interest than they're going to make on your cash. And that's what a securities lending industry is. When we did this at UTSA, I mean, you can add 5 basis points, 10 basis points to your portfolio return. So it's quite lucrative. There have been some blowups with securities lending. You know, if you take someone's collateral and you invest it, and what you invested in goes insolvent, you're at a loss. That's your problem. But it's a huge industry. I think Al Gore was actually on the board of a major securities lending firm. I think they were just buying his name. I don't think they really needed his expertise. I don't know what he knows about securities lending. But it is a major industry. When I was in 2008, when I was portfolio manager, we were getting letters from people saying, don't do any more securities lending. It's bad. It's harming markets. We said, we're going to keep doing it because it's benefits our policy, our investors. Any stock that was shorted that hit the news in the last few years? GameStop. Yeah, so you got this anti-shorting community. People don't like it and it's pretty crazy things. That's going to blow up eventually, but it's stayed up there amazingly. GameStop still we're not worth 20% of what it's trading for, but interesting. That's shorting securities. I don't recommend you do this unless you do it the paper portfolio first. Make sure you know what you're doing because it's possible for massive losses. So the best way to short securities, I think, is a paired trade. So I just mentioned Home Depot and Lowe's. So let's say you're watching Home Depot and Lowe's, and they move together all the time, and then suddenly they separate. Lowe's goes up, Home Depot goes down. That happened several years ago. You assume they're going to come back together. So you buy Home Depot, you short Lowe's, and you just hope they come back together. You don't care if they go up or down. You just hope that if they go down, that Lowe's goes down more than Home Depot, or if they go up, that Home Depot goes up more than Lowe's. So you buy one, you short the other. That's called a paired trade. You want them to be in the same industry. So you want high correlation so they move together. And you're looking for two stocks that normally move together that have separated, and you just buy one, short the other, and you've got your trade. We did this in the Investment Society a couple years ago. We did Walgreens and CVS, and that trade worked out really, really well. And then we did two others, and it worked out. So we added quite a bit to our portfolio with those two trades. It was a lot of fun. So pair trades work out better. They're not fail safe, but they're a little safer than just shorting the security, because at least markets rise 30%. At least you have something else that's probably rising the same amount, but it's still dangerous. There's a whole industry hedge fund strategy called market neutral. What market neutral does is just a bunch of paired trades. And it's called market neutral because they're saying we're completely uncorrelated to the stock market. The stock market could go up, could go down, but it has nothing to do with our performance. So we give you diversification because we're betting on two stocks being mispriced against each other. So you would think the beta of a market neutral should be 0. Historically, they've had betas of like 0.1, 0.2, but it's still pretty close to 0. So they tend to be somewhat unrelated. So you can look up market neutral as a hedge fund strategy and just see what some of them are doing. It's a pretty popular hedge fund strategy. It's a little different than long short equities. So market neutral, they essentially have 0 invested in the stock market. They're just long and short different stocks. Long short equity, they may have 130% invested in the stock market and have 30% short of the stock market. So they're essentially 100% in the stock market, but they're going long and short on a portion of the portfolio. So market neutral is a very unique strategy. The second thing you do is buy stock on margin. So this is essentially borrowing money to buy a stock. So you buy stock for 10,000 bucks, you put up 5,000, you borrow the other 5,000. Essentially, you're doubling your risk. The stock's up 10%, you'll make 20%. If the stock's down 10%, you'll lose 20%. So again, I wouldn't highly recommend it unless you know what you're doing, because it can be really dangerous. There are ETFs that do this for you. So 2 times ETFs. So essentially, you buy 2 times ETF, the market's up 10%, you'll make 20. They're essentially doing the same thing, leveraging up the portfolio. Expenses with investing. So this is the world that's changed the most in the last 50 years. If you do it yourself or if you hire a manager, so if you do it yourself, you used to have to pay a commission on trades, but that's essentially going to 0. I think I pay like 9 cents on trades now every once in a while, like on an option trade. Stock trades are free. If you're using Robinhood, commissions are free, but you're paying for the trade in another way, but you're still paying for it. But the commission itself, commissions started going to 0, I think, what, about 7, 8, 9 years ago? It was Robinhood that started the trend, and then Schwab and the others, Ameritrade, did the same thing. remembering that commissions in the 70s were like $50 a trade in those years, dollars. I'm not adjusting for inflation. So $50 back in the 70s is like $300 a day. I mean, they were expensive trades. And now we've gone all the way down to zero. So that's good efficiency. It's great that we've done that. A lot of that is because the broker is now a computer and it's not a human being. So that makes it a lot easier. You're doing everything online. The bid-ask spread is really where you're paying your biggest price. We're going to talk more about bid-ask when we do options. But bid-ask, when you're buying, you got to pay the ask price. When you're selling, you get the bid price. And there's a spread between those two. And so that's what the brokers is making. And that's your cost. That can be significant. In fact, if I see a wide bid-ask spread, I don't do the trade because I know there's something strange going on. And I've seen some stocks with really wide bid-ask spreads, and it's just like there's something going wrong here. I'm not going to touch this. Now, USAA, when we traded, we usually most of our trades got in between the bid and the ask. So we have pretty good execution. But you, as a retail investor, this is where you're really paying up. This is your big expense. And if the bid ask is 1-2%, that's what it's costing you to buy the stock. So if the bid ask is 1%, you're starting off with a loss of 1% just to do the trade. Because if you change your mind and sell immediately, you just lost 1%. If the market didn't move at all, you would have lost just 1% just for doing the trade and undoing it. So that's for small investors. That's the biggest expense we have now because commissions have essentially gone away. Market impact is the cost to large investors. When a Fidelity or BlackRock, when they have a massive trade, their trade will cause the market to move and they'll lose money because of that trade. They're trying to push 1 million shares or 2 million shares. That trade itself is going to overwhelm the market, create too much supply, and there's not enough demand. And so market impact is huge. You got to manage that very carefully. And there's an entire industry that does that called transition managers. And that's all they do, transition managers. Their goal is to help you with these large trades and to do it in a way where you don't cause a rift. The easiest thing to do, which I always loved doing, was to just settle with another trader. So let's say I need to sell 1 million shares and State Street, which is a large index fund, they're buying 500,000 shares that day. And I just go to State Street and say, you know what, we're selling 1 million, you're buying 500. Why don't we just swap the 500,000 and just whatever close price is, that's what we get. So there won't be any impact at all. So that's half of my volume is taken care of with this index manager. No impact whatsoever. That's good. I love that. That gets rid of half my trades. The rest of it, you need your transition manager to work the trade maybe over a few days to try to do it in a way that you get best execution. I don't know if y'all know that term, best execution. But that just means you get the best price you can. You're not giving money away to Wall Street. And so that's what they're trying to do. This is especially a big issue for small cap managers. Because if they're trying to sell 1 million shares and the average volume is 50,000, they're going to impact that market quite dramatically. So you may need a transition manager. I don't like transition managers. They feel like, I don't know if I want to say used car salesman because some of your parents might do that, but whatever, they feel like members of Congress to me. I think you can still badmouth Congress. Just shady. I don't trust them. The thing is, after they do help you transition a portfolio, they come with a report and they show you how much money they saved you. But they don't really know that because they don't know what would have happened if it done it any other way. So it's all statistical. I just don't trust them. I had a good friend that was a transition manager. He kept begging me to hire his firm. He worked for Credit Suisse, and he said, I know if you let me show you what we have, I know I can convince you. He could never convince me. And he was pretty high up there. There's a y'all probably don't believe me, but there is a transition manager magazine. Probably none of y'all, any of y'all subscribe to that. But this guy's face was on the front of that magazine probably half the year. Every other train, he was really well known. But he could never convince me. The reason he couldn't convince me, it was all statistics. He said, you should, on average, we'll probably save you this much, but no one really knows. So I just stuck with the large index houses. So yeah, it's an interesting interesting field. That particular guy, just to show you, how flexible you got to be. He went to New York to be an actor, failed at that, so became a transition manager. Did that for a couple of decades, became one of the best, and now he runs a hedge fund in India. So pretty interesting career, right? He's all over the place. But I don't know how acting helped him with transition manager other than the show he put on to try to convince him to hire his services. And then he went to hedge fund. He was from India, so he went to India to start a hedge fund to energy. So there's a lot that you learn in finance that transfers to other places very, very easily. If you're going to hire a mutual fund, then you got expenses from the mutual fund and their fees. And the fees can be really, really high, or they can be very, very, very low. I would never buy a fund that charges a front end or an exit load. There's no evidence that you're getting anything for that other than just losing money. There's no evidence that higher fees mean better returns. So passive investing gives you huge investing advantage. Passive investing, they say, I saw an article, 2022, finally active management did better than passive, and I just don't believe that at all. But passive management beats active probably 85 to 90% of the time. There have been studies shown, but they said last year that wasn't the case. Well, I'll just tell you, anytime small cap stocks outperform large cap stock, active managers beat the market. And why is that? Because large cap managers love to buy small cap stocks. And so they're not beating the market because they pick superior large cap stocks. They beat the market because they bought another market. They bought small cap when small cap did well. So that's cheating. So anyway, I think you're better off. I think if you don't have a degree in finance, you're better off with passive, I think 100% of the time. Absolutely. So, all right, I'm going to move on. I see people on their phones, so that really distresses me. So I'm going to move on to a topic where it's on an exam, so I can use the exam stress. All right, so we're going to calculate returns and calculate risk. This is really, really important that you understand how to calculate a return. So we're going to do a holding period return, and then we're going to link that together to analyze risk and other things. So a holding period return is some period of time, usually monthly, but it doesn't have to be. Where I work, we did daily returns for stocks and monthly returns for bonds. So it just depends on the nature. It's hard to do daily returns on bonds because bond prices are not all that reliable. The stocks you can do every single day. We did quarterly returns on real estate because real estate doesn't make sense to price real estate every single month. So usually for stocks and bonds, it's a monthly holding period. You can do weekly or other things, but monthly is the most likely. We're going to use this formula. It's going to be the ending market value minus the beginning market value plus accrued interest or accrued income divided by beginning market value. Now that's not allowed by the CFA Institute. You'll actually have to say that on the exam because you're not allowed to use this type. Well, we'll see what you have to actually say. So CFA actually says you got to use the modified Dietz. Now modified Dietz is out there. You can look at their formula. It looks a little bit more complicated. So what is modified Dietz trying to do? So the beginning minus the ending minus beginning is still in there, but you notice here they have this sum of weight. What the modified Dietz is doing is trying to take out the effect of a trade during the month. So our formula works really, really well as long as you didn't buy or sell anything during the month. If you bought or sold something during the month, let's say you went out and bought $20 million worth of stock, so your market value is $20 million higher. Well, that's because you put $20 million in the stock market. So obviously you got to adjust that out somehow. This formula doesn't do that. This formula assumes you didn't do any trades during the month. Well, if you did a trade for 20 million, how do you adjust for that? Well, if you did it the first day of the month, that has a big difference than if you did it the last day of the month. So you got to adjust that out. And that's what the modified Dietz is doing. The modified dates is adjusting for the timing of the cash flow. If you want to see modified dates, we use it in the investment society, so I can show you the actual formula that we use. It's not that bad of a formula. It works really, really well. It's the same components: beginning value, beginning market value, income. It just adjusts all of that, including the income, for the timing of when the cash actually came or was invested and deployed. So that's modified dates. You can see the definition of all that. Now, our industry uses time-weighted returns. Why do we use time-weighted returns? We're gonna see time-weighted returns here pretty soon. So hold on to that thought when we do it. But our industry is required to use time-weighted returns. What is your actual return? Your actual return is your dollar-weighted return. So we'll see. Can those be different? Yeah, Jack Bogle wrote an article where he showed over a long period of time, the dollar-weighted return was 40%, the time-weighted return was 0%. So the industry advertises, I said that backwards. The time-weighted return is 40%, the dollar-weighted was 0. The industry advertises 40% when their customers actually make 0%. So does that sound materially different at all? Or is that about the same, 40% versus 0? Which would you rather make? 40, 0, coin toss. There's a difference in those two. But our industry reports to 40, doesn't report to 0. And we'll talk about why that is. A lot of it has to do with some dishonesty, I think, but there is a good reason for it. The accrued income, we're not going to handle this with bonds. You should have done that in your accounting class. With bonds, they pay twice a year. So if it pays in June, but you're doing March's return, you're going to put 1/6 of that income into return. Your accounting classes do that. Remember, there's a simple interest way, and then there's the actual where you do the IRR approach. We're not going to worry with all that. I'll let your accounting classes do that. Stocks, though, we are going to do with stocks. The key with stocks is, when is the ex-dividend date? That's the date that matters. Now, with the modified dates, it's the actual payment date. But for accrued income, if you're accrued income, you accrue it based off the X date. All right, and we'll see that when we look at some of the numbers. The X date, so there's 3 dates. There's the announcement date, the X date, and the payment date. The announcement date is not important. They're just saying, hey, we plan on paying a dividend. The X date is the date that if you own the stock on the X date, you get the dividend even if you sell the stock the next day. All right. So X date is when you're guaranteed to get the dividend. And what happens on the X date is the stock will fall by the dividend amount. Because if you sell the stock tomorrow, you get the price of the stock, but you're also going to get the dividend. So you can say, hey, the stock fell by the dividend. That's no fair. I'm selling the stock. But that's true. You sold the stock and you got it less the dividend, but you're going to receive the dividend in a few weeks. The person who bought the stock from you, they get the discount because they're getting the stock, but they don't get that dividend. All right. So the stock will fall by the dividend. So the X dividend date is the date you care about. So I'll give you the 3 dates on the exam. When you're calculating, say, February's return, you got to say, do I put the dividend in February or do I put it in March? You just look and see when the X date is, and that's the month you want to put the dividend in. All right. So let's work some examples. So let's do Costco. So the holding period return equals ending market value minus beginning market value plus income divided by beginning market value. So we need ending market value, need beginning, need ending market value, beginning market value, income. And let's do, well, it's March. We'll do March. So we'll do February, January, and December. So what's my ending market value? So we got open. That's what trades at the beginning of the day. You have the high for the day and the low for the day. You have close and you have adjusted close. Which close do you think we're going to use? In this case, you're going to use close. Now, when you do your beta on paper 3, you're going to use adjusted close. What's the difference? Well, the adjusted close, what they do is they reflect the fact that dividend, when it's paid, causes stock price to fall. And so what they do is they say, hey, what if we took that dividend, just reinvest it in the stock? So essentially, adjusted close is going to be a true total return. So if we use adjusted close, we would have to use income because adjusted close already adjusts for the income. But we're actually going to bring the income in. So our ending market value is 484.18. Now, what is my beginning market value? So which date do I use? Beginning market value. I hear 5 so which is it? 517 or 511? Are they open? Which would you use? So it's not the open. I can see the logic there, but it's not the open. It's actually the prior month's close. All right, prior month's close. 511.14. And what was January's ending market value? 511.14. Right. So you had to line them up, because if you use the open and we use January 31st for the close, we'd have like the difference between January 31st's close and February's open would be missing in our calculations. So we're going to use January 31st as both our ending value for January and our beginning value for February. Everybody see that? And then what is my January beginning value? Be December 30th. Why not December 31st? That was a Saturday, so it didn't count. 456.50. And my December opening value, 539.25. I just forgot what I said. 539.25. All right. Now, are there any dividends in here? There's one right there. So what do you think Yahoo Finance has given us? The announcement date, the X date, or the payment date? 9 cents on February 2nd. Any guesses? 9 cents is a pretty, or 90 cents. 90 cents is a pretty pathetic dividend for a $500 stock. Costco is a little bizarre in their dividends. I'll show you here later, but they may guess announcement, X, or payment. Payment would be logical, but that's not what they give us. Not announcement. X date. Good. Y'all got it. Yeah, I knew y'all know that. All right. So X date. So the reason they give X date is because that's the number that affects the price. So they want you to know, hey, you got to look at that price change, but you got to realize, do you notice there's a difference? Look here, the adjusted and the close are the same until when? Right here. What did they do? You're going to notice that the adjusted it's going to be smaller when a dividend's involved. They're adjusting that dividend into that price for you, so you can compare it. So what they're saying is the price would have been 90 cents higher if they had not paid that dividend. So it went X dividend on February 2nd. So which month gets the dividend? February. All right. Let me show you your dividends because Costco is so strange. It's one of the most bizarre companies. 90 cents, 79 cents, 70 cents. Anything stand out in there? $10 dividend. That's a big dividend. They did that December 2020. Oh, I meant to do historical prices. Let's see if it will. So there's that $10 dividend. Can you see it in the price? You don't really notice it that much because they fell $4. They still fell 1%, but they would have, it would have fallen much less. I mean, they probably would have been up. In fact, they would have been up on that day if they had not paid that dividend. So it's interesting. I'll see if I can show you another one. One of the most amazing ones I've ever seen. If I can type. Here's a $10 dividend. This is not a $10 dividend on a $500 stock. This is a $10 dividend on a $30 stock, or well, at the time that they did the dividend. So let's look at that one. I think that one, because we own this in our portfolio and we panicked. Like, where did it go? Okay, August 2012. So look at that. Their stock went from $43. Can you imagine? I pulled the portfolio and we have Choice Hotel, and the stock went from $43 to $31 in one day. Like what? We just lost 25% on one stock. I'm looking at the news that they have bad earnings. No, there's no earnings reports. And then I saw that they paid $10 dividend. But look at the adjusted. The adjusted hardly moved. Why? Because they're taking that adjustment in there. All right. So you can see if we were to calculate their return, if we didn't put that in the same month as the X date, we would really miscalculate their return. We would have it completely wrong. You have to have that $10 in. When you have that $10 in, the stock didn't really move all that much. But without, if you don't put that dividend in there, it'd be huge. Or you can use the adjusted and you should get the same type of return. All right. So income. So let's do our return. Holding period return. So you do ending market value minus beginning plus income divided by beginning. So they were down 5%, up 11%, down 15%. It's been a pretty wild ride for Costco here. And then looks like this month is not all that much better. Let's see, 484, where are they today? $483, I guess they're flat this month, but it's been all, well, they were up 2% today, so they were down until today. It's been pretty rough for them. But there's the returns. So we got 3 months of returns. But each one of these is a holding period. So what are we going to do with these holding periods? So we want to link the holding periods for multi-period returns and to assess risk. All right. Generally, we'll have probably 24, 36, whatever, many months of holding periods. So we can do much more sophisticated analysis. On paper 3, you're going to do beta, which is using holding period returns. You can do beta, but you can do it over 5-year periods, rolling 5-year periods. So you may have 20, 30 years worth of data. So we need to link these together because just by themselves, I mean, this is pretty negative. but that's only 3 months. So in reality, we probably would have done, several years worth. Costco is obviously a great company, has done really, really well, but this last few months has been pretty rough for them. So how do we link them? So there's 2 ways to link. There's arithmetic average and there's geometric average. Arithmetic is the easy one. Geometric is the one that takes a lot of extra calculations, which is the only reason on the exam I gave you 3 periods instead of 50, is because it would take you forever to do, even with arithmetic, it would take you forever to do that months of averages. Now, if we could take the exam on Excel, then I could have you do 5 years worth of data really fast, because it wouldn't be that difficult to do. All right. And we want to do both the monthly average and you want to annualize. Same thing on geometric. You want the monthly average and you annualize. And this is when you put the footnote, CFA Institute to not allow annual periods shorter than a year. We only have 3 months worth of data. You're not allowed to annualize 3 months of data. It's not allowed. Now, if you go to the Bloomberg machine and plug in 3 months, they will annualize that. But they're not officially reporting anything. They're just giving you some numbers. They just, they could leave it blank, but they just decided to put that calculation in there. So I'm giving you 3 months on the exam. You would have calculated these 3 holding periods, and then you're going to do the arithmetic and geometric monthly and annualized averages, but then you're going to have to put the footnote, because I want you to just be aware, you're not allowed to annualize 3 months worth of data. That's not how you spell holding, though. So 484 minus 511 plus 90 cents divided by 511, 14. Anybody else not get that number? Well, that's what they showed. On February 2nd, they paid a 90-cent dividend. So the stock I give you on the exam, I got to find a stock that paid a dividend. So I'm not going to give you Alphabet. So I'll have to find a stock that paid a dividend, and then I'll give you the announcement date, which I'll probably just make up. I'll give you the payment date, which I'll probably make up, and then I'll give you the X date, which is the only one you care about. And the announcement and pay date will be different months than the X dates. So all I'm looking for is to use the X date. All right, other questions? This is a simplified holding period return. It's fine. It really works perfectly fine as long as you're not doing trades. If you're doing trades, you're gonna have to probably use the modified dates. Modified dates, it looks complicated. You look at the formula, it really is not that difficult. One thing you have to do with modified dates is you have to say the exact date that you bought the stock. You have to keep that, and you have to know the exact date that the dividend was paid. When you're doing the modified dates, it's the date that dividend was paid. So what that means with modified dates is you add the dividend to the month and when X date, and then the next month when it gets paid, you put the actual date of the payment, and then that goes in the calculation. So you have to kind of keep track of dates of all cash flows, because it's really critical to that calculation. All right. Now, when we calculate these 2 things, one of these numbers will always be equal to or greater than the other. And that's how you'll know on the exam you did it correctly. The arithmetic is always equal or greater. But there's a catch. The monthly the monthly arithmetic is always equal or greater than the geometric. The annualized can be all over the place, depending on what it's doing, but the monthly must be equal or greater. So if you get an arithmetic monthly average that's less than a geometric, you made a mistake somewhere in your calculation. So that's a good way to test to make sure. I don't count out for math errors, but if you have that problem, you need them put on the test. I obviously did something wrong because arithmetic is lower. That way I won't count off for the math error. If you get a math error and your arithmetic is lower because of the math error, then it count off because you didn't notice it was wrong because it was different. So let's do the arithmetic. The arithmetic is really easy. You just take minus 0.051 plus 0.1197 minus 0.1535 divide by 3. It's just the average of those three numbers. So arithmetic average, very, very, very simple. So on average, Costco is down 2.83%. Annualized, real simple. You take the monthly average and multiply by 12 with the footnote. So arithmetic, you know how to do an average. It's just an average. So arithmetic average is normal average. Why the footnote? Because it doesn't really make sense to annualize 3 months worth of data, especially as volatile as this is. Now, geometric, what I'd recommend you do on geometric, you have this long calculation you got to do. You need the same calculation for the monthly and the annualized. So you need to get the first part of the calculation, write it down, so then you can do the monthly and annualized. But the geometric is you're going to take 1 plus month 1 times 1 plus month 2 times 1 plus month 3, etc. You're going to raise all of that to 1 divided by 3 minus 1. So you have to link them all together. So 1 plus the negative 1535 times 1 plus the positive 1197 times 1 plus 1 minus the 5.10%. All of that, you need that, going to raise it to the 1/3 power. So this, inside this bracket, you need that for the monthly average, and then for the annualized average, you do it the exact same way. It's just that instead of raising it to the 1/3 power, you raise it to the 12/3 power. But what if this had been weekly? What would you have done? This would have been the same, and that would have given you weekly average. But if this had been weekly, we would have raised it to the 52 over 3, because you have 3 months and you need to annualize it. All right. So if you're doing monthly, which is most common, you raise it to the 12/3 minus 1. So you can see you need this bracket is the hard part. That's a lot of data and a lot of calculating. So you need it for both of these formulas. So if I were you, I would get that on the exam, write it down, and then raise it to the 1/3 power minus 1, and then raise it to the 12/3 minus 1. All right, or put it in your calculator or memory or whatever. So here, 2 parentheses, 1 plus the first month, 1 plus the second month, plus third month, raised to 1 divided by 3 minus 1. And it better be a lower number than 2.83 if I did it correctly. And sure enough, it is. And here I'm going to do the exact same thing again, but I'm going to raise it to the 12/3. That one, it is lower than the the arithmetic, but it doesn't, annualized doesn't always have to be lower. You can get some strain, especially on positive numbers, it can get pretty wild. If this was 40 months, you still multiply the arithmetic by 12. But if this were 40 months, you would do 12 over 40. Right? So however many months you have, that's what's in the denominator. However many months there are in the year, how many periods are in a year, that's what's in the numerator. All right. So what would I raise it to if I were doing this weekly or 60 weeks? What would be, I would raise it to the what? 60, no, 52 over 60 minus 1. All right. So that however many periods you looked at, that's in your denominator. However many periods there are in a year, that's what's in your numerator.
Minus one of the exponent, or is it?
No, it's the whole thing is after the entire thing. So it's just the very, very end. I mean, I've got it like that. I could add other parentheses if I want to, but you get the same answer. So yeah, it's after you do all of that, you should practice one. Essentially what we're doing is saying, I took this $1 and put it in Costco and I lost 15 cents. And I took that 85 cents and the next month I made 12%. And then I took that, whatever that is, 95 cents, and I put it back in Costco and I lost another 5 cents. Essentially, that's what this formula is saying. And then you take that, what you had, and you calculate that return based on starting with $1. So it's essentially telling you how much you lost on average with that $1. Now, why does arithmetic have to be less than a geometric? And it has to be less because of standard deviation. If there's 0 standard deviations, the 2 returns will be exactly the same. But if there's any standard deviation, the arithmetic will be higher. Let me just give you an example. Oh, we're out of time. All right, I'll give you an example next time. And I'll show you why geo and arithmetic. Because you're going to find geometrics the one you actually care about, but arithmetic's the one we use to report. All right, so we'll do this again. We'll have a little more practice next time. If you didn't get your paper, come get it. So we'll get back from spring break and we'll go right into the exam. I forget when it is. So it's on the Thursday or Wednesday when we get back. So we have one day to talk about it. So I'm not going to talk about it today other than maybe show you an example paper. So here's a paper from last semester. He put it in a pretty good format, similar to the first paper. You don't have to do that, but this is question 1, does the 3 questions, the why, what, and how. And then he goes to the asset classes, major asset classes, cash equivalents. Don't forget to talk about cash versus bonds. Some students completely forget to talk about the reinvestment risk versus the interest rate risk. That's really, really important. Duration, he goes in each one of those. Remember, on each one, duration, convexity, whatever, you've got the definition, you got the subclasses, and you got the strategy. You got to make sure you cover each one of those. So what is duration? What are subclasses? Short-term, intermediate, long-term. Strategy, rates are rising. You want to shorten those kind of things. He does an introduction on stocks, which is really, really important. What is a stock? Talks about the bucks, but does them in the right order. BCSU. Then alternatives. He goes to each one of those. So it's all there, but in his own words. So some students start well and then they kind of peter out after about a third of the way through and then just kind of stops. You might say, well, that's a lot for us to have to put down. My previous classes, we did this in-class closed book, so you don't really have much of a complaint. How much of this should you know off the top of your head? Somewhere around 100% of it. There's nothing on that that you shouldn't be right off the top of your head without even looking at the notes. You should know all of this is what you know. You're a professional, so you know stuff people on the street don't know. This is a pretty basic thing to know. So I've given you a template. I just want you to put the template in your own words. It's a good template, so I'm not giving you some crazy thing that's going to throw you off. All right, so you probably should get that. Hopefully, you've already finished your draft and you're just editing it down, but definitely get it done over spring break. Unfortunately, we're going to have kind of nice weather for spring breaks. So, you know, in the past, it's been like 40 degrees. You're sitting down there and, you know, in Port Aransas and 40-degree weather. So you might as well do your paper now. You have some excuse, but go out to the beach for 5 hours. You're going to be sick and tired of the sand. Come back in and write your exam question one. You might as well. Maybe your friends that are all intoxicated maybe can help you on the paper. They may have some good ideas how to put it into your own words. All right. Any final questions on the exam? We'll talk once when we get back, and I'll put the link on Blackboard as you can submit it. And then question 2 will be in class on Thursday, the first 30 minutes, and we'll have regular class after that. It'll look just like what we've been doing in the 2-team competitions. So you should have that down as well. You've seen exactly what it is. I always think I'm really clear on the exams. I had an exam where I thought it was so clear, and the student said, "Is this multiple choice?" And I'm like, "What are you talking about?" So I'm hoping everybody understands me. So you know exactly what the exam is going to look like. All right. So we were measuring risk of return before. We're using this formula, this simplified formula. We should be using modified deeds, but we're not going to. This simplified formula works really, really well if you don't have any major you don't have any transactions during the period. Waylon heard this last night, maybe Lance. Yeah, Lance did. So last night we had a guy come in and teach us Bloomberg portfolio, which does all this stuff really, really cool. It's amazing what it does. I'm going to edit that video and get it out there on our Investment Society University. Really cool stuff that you can do some amazing stuff with Bloomberg to really assess a portfolio. I was shocked at just how simple it is. Well, it's not user friendly. So if you sat down at it to say, what do you do? It would not be easy. You have to watch what he clicks on because it's not obvious what to do next, but really, really powerful stuff. So there's a lot more to this than what we're doing. This whole concept of attribution, of trying to figure out why did you have the return that you had? That's really, really critical. Most people who invest have no clue. What was it that they bet on that worked? What did they bet on that didn't work? So, so calculating returns. And then once you have those holding period returns, now we can do some analysis of them. So last class we did a stock. We'll do another one today, but we did a stock where we came up with 3 holding period returns. Then we annualized it. We took the monthly average, annualized it, took the geometric monthly average, annualized it. These formulas use all the time, pretty common. And then I said the geometric average will always be equal to, but usually lower than the arithmetic average. Why? Because of standard deviation. The geometric average should equal the arithmetic average minus half of the volatility, or half of the standard deviation squared. We'll actually test that today and see if that's the case. And then we'll get into risk. So let's do a little more practice with calculating returns, because it's a really critical thing to do. Let's do a couple of them. I don't know what stock would be interesting. Well, we can do Meta. We did a bad one last time. We'll do a good one this time. So I'm going to bring in some historical data. What did we do last time? I can't remember. Costco. All right. So let's try Meta. So we're going to do their February, January, and December. We need an ending market value, beginning market value, And so what's February's ending market value? So we're going to use the close. I don't think they paid dividends, so I don't think it's going to matter. I guess it's possible they may have once, but yeah, they don't pay dividends, so we don't have to worry about the dividends. So we're going to use the close, but it doesn't matter here. Close and just close if they don't pay a dividend will be the same. I was telling my risk management class last night, you're doing a mutual fund, you have to be really, really careful because the adjusted close, I think I could tell last night that they're still not fixing this. The adjusted close adjusts for dividends, but it doesn't look like it adjusts for capital gain distributions. That doesn't apply to a stock. A stock doesn't distribute capital gains, but a mutual fund, if you use Yahoo Finance or a mutual fund, you're probably going to grossly understate their return because anytime they distribute capital gains, that's going to be a negative to the return. So we can use either one of these last two columns. So their ending market value, 174.94. Everybody see that? 174.94. I wish on the exam we could do it in Excel and you could go on the internet and get the numbers yourself. That would be better, but you can't do that. And then what's the beginning market value? So someone yell that number out. Yeah, 148.97. So January 148.97. Which is the ending market. So your ending and beginning have to be the exact same number month to month, or else you'll miss a return. And then the January beginning market value, 120.34. Everybody agree? Why isn't December 31st? It's a Saturday, so it's the last number of the month, 120.34. And then the December beginning market value, November 30th, 118.10. Dividends are zero, so don't have to worry about dividends. But if we had a dividend, which date would we care about? The X date. All the other dates just ignore. It doesn't matter. Now, when you do modified dates, you have to know the payment date. So the X date, that's the month you're going to accrue the dividend into, because you know, like if we went X in January and they paid in February, you know in January the stock price fell by the dividend. So you're essentially just going to accrue that dividend to January. You're just going to add it to the end of January's value. And then in February, you're going to actually put the dividend in on the exact date for the modified dates. And then because you accrued the dividend to January, that's going to reverse in February. So those are just going to be a wash, but the deets, so the dividend is actually going to show up as part of the return in January, but the modified deets is actually going to bring it in on the right day for the payment date. So it's a little bit more than what we're doing here. So for the holding period of return, we're going to take ending market value, beginning minus beginning market value plus income divided by beginning market value. So here, pretty straightforward. Ending market value minus beginning market value plus dividends divided by beginning market value. Pretty decent return. Pretty decent return, pretty decent return. There's still volatility there. There's still a standard deviation there, even though they're all positive numbers. So remember, volatility is looking how far you are from the average, and there's definitely a long distance from the average. All right, so let's do the arithmetic average. So that's just the sum of the 3.1743 plus 0.2379 plus 0.019 divided by 3. Now I have students, I think this might be a calculator issue. You have students who don't realize that 23.79% is 0.2379. So you should do everything in decimals, right? Don't convert it to integers or whatever. Do everything in decimals, especially on the geometric link. If you take 1 plus 23.79, that's 2,300%. That's not 23%. So some students actually have that issue. So there's my average return. We can check it using the average function. So we got that right. And then we're going to annualize with a footnote at the end. Anybody remember how to do that? It's a pretty strong case not to annualize 3 months of data, right? So what's the annualize here? No takers. You're doing the geometric, so not the geometric, but that's very good. You might remember that, Amanda, because that's the formula I thought y'all would forget. I thought y'all remember the arithmetic annualized. No one remembers that times what? It's 12, right? Because it's monthly. So it's gonna be a massive number because, and that's the reason you don't annualize 3 months worth of data. And so we have to have the footnote. CFA Institute. It's not annualizing periods of less than 1 year or 12 months, whatever. But again, if you go on the Bloomberg machine and calculate through the COMP function, they will annualize. They'll annualize 1 day. I mean, they'll take 1 day and multiply by 365. So their formula is just set up to do that. They don't have a footnote or anything. All right, so now Amanda got this geometric average. So she was saying 1 plus the first month times 1 plus the second month times 1 plus the third month. And then what do? You remember the rest of it? And why 3? Why not 7 or 12? That's how many periods we have. Okay. And then what else? Minus 1. Now we can see if it works here. It probably won't because we have so few periods. But if you take the arithmetic average minus 1/2 of the standard deviation square of the volatility, how close does that get to the geometric? Pretty close, doesn't it? So why are the arithmetic and geometric different? I'll show you mathematically why, but it's because of standard deviation. If standard deviation is 0, they'll be the same. If standard deviation is 0, 10%, 10%, 10%, they'll come out the same. They're exactly the same. So if there's no standard deviation, they're the same. If there's any standard deviation at all, geometric has to be lower. All right. And then we'll do the annualized geometric, which is the exact same formula again. That's why you want to save it in your calculator. What's the only adjustment we're going to make? So change the 1 to 12 on Y12. How many months in a year, right? So if it was weekly, you'd use 52. Now, if it was daily, what would you use? That one's kind of tough. You use 365, 366, 365.25, 250, the number of business days. Daily is a little bit of a mess. We're not really sure what to do. So we tend to stick with monthly and weekly. So yeah, I don't know many people that annualize. Well, I have annualized standard deviations and so you can. I usually use 250 if I'm annualizing daily data, whether it's standard deviation or now you notice I said on the annualized geo can be higher than annualized arith. Now here's a good case when you have really high returns. When you compound that high return, you can get a massive numbers. So here it will be higher, but the actual average unannualized must be lower on geometric. the annualized number can be higher. Okay, so don't freak out on exam if your annualized geo is higher. That's not the piece that you have to worry about. All right, we put the footnote there as well. I believe, pretty sure Bloomberg uses the geometric average when they show return, but I'm not 100%. I'll have to go back and look. They do it price only, which for Meta wouldn't matter. They do price only, total return, including dividends, and then you have a column to annualize it. And I think the annualize is the geometric, but I'd have to go look. All right, so why is geometric higher? I think we did this last time, didn't we? No, maybe we didn't do it. I can't remember, but we'll do it we'll do it again if we didn't. So did I talk about your uncle last class? Gives you $100,000. Seems like I said this, but I can't remember. You invest for him. The first month, you're up to $150,000. Second month, you fall to $75,000. So what is your holding period return? Ending market value minus beginning market value plus income divided by beginning market value. You made 50%. The next month, you lose 50%. All right, does this sound familiar? Did we do this? Maybe I didn't. All right. Wait, I'm mixing up last semester with 2 days ago. That's how freaky time's getting to me. So what's the arithmetic? Well, you take 50 minus 50 and divide by 2. So you call up your uncle and say, well, how did I do? He said, well, you started with 100,000. Now you have 75,000. So your average return was 0%. And is your uncle going to buy that? Does he feel like he made 0%? He would have liked to make 0%, wouldn't he? Then you do the geometric average. 1 plus 50% times 1 plus that. Raised to 1 divided by 2 minus 1. And that says his average return was negative 13%. Which of those numbers is he more likely to buy? Probably the negative 13. So geometric is the more accurate number when looking at historical numbers. And you want to use geometric if you're using historical numbers. What the industry reports is actually closer to the arithmetic, although they're doing dollar weighted versus time weighted, which is a little bit different. But geometric is your actual true return. So if you're setting this up into a spreadsheet for your own portfolio, you want to get the geometric average. Now, someone showed me last semester, but I can't remember, and I could never get it to work, that the arithmetic average is really easy in Excel because there's a formula, just equal average. A student told me that Excel has the geometric average built, but I could not get it to work. So a student sent me the formula, and I said, wow, that's great, that's wonderful, but I couldn't get it to work. So I'm pretty sure they must have the geometric average formula in there that you can just actually put it in there. I don't think it's equal geometric or whatever. So geometric's more accurate. Now, what if you're forecasting this portfolio for next month? Your best forecast then would actually be 0%. So arithmetic is the best forecast for your next month and going forward. Geometric is the best representation of your history. I had this debate at UTSA because we were building a simulation model, and I put arithmetic averages in there, and the finance planner said, no, that's too high. You should use the geometric. And I said, no, we're going to use the arithmetic because when we run simulations, we're going to get standard deviation, and the resulting geometric average will be correct. The arithmetic will be higher, but the actual resulting return that we get will be the geometric. If that rings at all, I mean, it should, right? If I'm going to run scenarios against this number with up and down, I'll end up with a geometric average much closer to the actual numbers. And why is that? Well, because if you make 50% and then lose 50%, you made 50% on 100, but you lost 50% on 150,000. You have to make more to make up what you lost. So if you lose 25%, you can't make 25% and be back to square one. You got to make much more than 25%. It's just the nature of numbers. And it's because your denominator now is a smaller number. So your denominator was 100, now it's 75. To get back to where you were, you're going to have to make a higher number. So, but that's the difference in these two. So some people are like, well, why would you ever use arithmetic? But it does have a purpose when you're forecasting into the future. It is the best number to use. All right, let's do this again. What stock do I want to use? Well, Microsoft has been kind of interesting here. Microsoft was a firm we're talking about how horrible they were in going out of business and old school. And then they reinvented themselves in a pretty major way. We keep waiting for IBM to do that, but IBM hasn't quite figured that out. So I'm going to bring in some monthly data for them. We'll do max. They do pay dividends, but we're going to use the adjusted close, so that won't be an issue. You may know the credit rating for Microsoft. AAA, the only AAA left, or one of the few AAAs left. So we're going to get rid of everything but the adjusted close. Now, their stock was not 7 cents in 1986. The reason it shows 77 cents is a couple of things. First, dividends. So this is adjusted for dividends. So if you look at the actual price, I probably should have left it in there. Well, even that's going to be much lower. So dividends, you can see the adjusted close is much lower than the close, but they also adjust this for stock splits. So if you have a stock split, they'll go back and adjust the historical number. You got to be careful because they mess up sometimes. So anytime I'm looking at data, I like to look at the actual data as a graph. Because if you see your stock drop 50% in a day, there's a chance they forgot to adjust for a stock split. I've seen that in a couple of stocks. We're calculating beta or standard deviation. Like, my word, the stock dropped 50%, and they just, for some reason, didn't update their database. The other thing I have seen is a stock price where they put the decimal in the wrong place. And that'll usually stand out as well. And you want to go back and fix that. So I use it. You can see why I like to graph this. And even better, change the format and do the logarithmic. And then it really stands out. So don't trust Yahoo Finance. They have mistakes. But it's really easy to find. Something like that. I mean, it's pretty amazing, right? They meant to type 0.28 and someone actually typed 28 point something. That's really possible to do. But it usually stands out. It's unlikely that happened in one day for Microsoft. So it looks like this data is pretty good. So if you put 7 cents in Microsoft in 86, that 7 cents would be worth $254 today. That sounds like a pretty decent return. But what is it on an annualized basis? So we're going to do the holding period return. This is Lance and Wayland will be doing this in their risk management class project. So ending minus beginning plus income, which is 0 here. So they had a pretty good first month there. Now, you might say 8 cents versus 7 cents. It's really not 7 cents. It's actually 6,986. So they used to, that's the other thing Yahoo Finance used to do that they fixed. They used to round this to exactly 7 cents, which would really distort those first few numbers. But they actually go out several decimal places now. So they fixed that, because if you only go out one decimal place, it could look like, you go from $1 to $1.10 or whatever, 10 cents to 11 cents, just because it's rounding. It looks like a 10% return, where it really just went from 10.49 to 10.51. So, you got to be careful on that kind of thing, but they fixed that. how do I copy this down? Y'all know how to give me a heart attack? That's how you give me a heart attack. Well, you're not going to do that, right? So what do? Yeah, just double click, right? You got to get, well, the key is to not use your mouse ever again, but I didn't learn Excel without a mouse. I learned Lotus without a mouse, and I got really good with Lotus without a mouse, but I haven't adjusted back to Excel without a mouse. But so there's our holding period returns. And so now we want to do the arithmetic. So there we just do equal average of all of these. And it's 2.3%. You might say, well, that's not that very high, but that's monthly. So then we'll annualize. Just multiply that by 12. Bill Gates. We get really, really high number between Bill Gates and Zoom. I'm having to push a lot of buttons I don't want to push. So 2763, you know the geometric average will be less than what? Less than 2.3. You know that for sure. Let's get the number of months. We're talking 443 months. So to get the geometric, again, there supposedly is a formula in there in Excel. If y'all find it, let me know. But what I'm going to do is just show you mathematically what the geometric length is. It's assuming you start with $1, and you take that $1 and you invest it in it. So at the end of that first period, you have $1.09. Then the next month you invest it again, and now you're down to 95 cents. So essentially what the geometric length is doing is actually what you're most interested in. It gives you that actual ending value of your portfolio. So if you started with $1 in Microsoft stock, you'd have over $3,600. That stock today would be worth over 30. If you put $1, because you would have bought, I don't know how many shares, 12, 13 shares at 7 cents each, you'd have over $3,600. So what is your geometric? You take this and you raise it to the 1 divided by 443 minus 1. You get, does that look like that could be it? Maybe let's try standard deviation. Standard deviation is 9.5%. So let's take the arithmetic. Well, sorry. One row too many. So let's take the arithmetic minus half of the standard deviation squared. Pretty close, isn't it? So the reason it's not the same is there's some skewing, slight skewing to Microsoft, but not much. It gives us pretty close. In fact, that's one way you can figure out real quickly if a particular data series is normally distributed or not. If the arithmetic minus half the volatility doesn't get you really close to the geometric, there's some skewing in there, and it kind of tells you. Now you can use kurtosis and other ways to figure that out, but it gives you a pretty good answer. And then the annualized geometric, same formula again, except for here we do 12 over 443. We get 24.87. That's a pretty good return over 40 years. 24.87% a year. If y'all like, if I could tell you for sure a stock was going to do that the next 40 years, would you put money in that stock? I'd put all my money in that stock. What if I told you the standard deviation is really high? I say, who cares? Right? If I told you the geometric was 24, if I told you the arithmetic was 27, if the standard deviation is 800%, that might make you a little nervous, right? So your true return is the geometric. So if I tell you, hey, I know this stock for sure is going to make 25% geometric average over the next 40 years, I think I'd put all my money into it and just be done with it. That would be the way to do it. Right. So you can do a lot with this. You got standard deviation there. We could do beta, but we have to have another data set. We do correlations. There's all kinds of stuff we can do. But our main thing is to just talk about this. Obviously, it'd be interesting to see what the S&P did over that time. I'm sure it was much less than that. When you actually look at it, though, it's kind of interesting. It's going to look the same as the graph we just did. It's going to look kind of interesting because you see there, this is when they were probably there was a point where they were the largest stock in the S&P 500. And that didn't last very long, but they shot up there. They were the darlings. And then you can see nothing sideways. And then they reinvented themselves. I mean, here recently, all the growth stocks have sold off. So they've all done that. But this is probably 2008. But yeah, just could do no wrong, and then suddenly the iPhone shows up. It's like, who needs Windows anymore? I don't know if you remember, y'all weren't in this age. Your parents probably remember this. Microsoft had it made. They would upgrade Windows every year or two. USA would go out and spend millions of dollars upgrading Windows. And it was just, I mean, it's just this cash cow that would just kept feeding and feeding and feeding. And then suddenly Steve Jobs comes along and says, you don't need Windows. And it's like, oh, interesting. Not just because of the Mac, but because of the iPhone and iPad. It's pretty amazing. But they reinvented themselves. How? I mean, they're doing cloud, they're doing AI, they're doing gaming. They're a very different firm today. So, but I would still wish I had all my money in there anyway, even this sideways. I'd be nice if I'd known to take my money out here and put it back in here, but I'd still be in really good shape. Microsoft's one of those stocks that if you think you can find, let's say you have 20 stocks and you think one of them's Microsoft, you can lose. It's pretty interesting. If you put well, you can almost even guess. If you put $10 or you put $20 into 20 different stocks, you put $1 into 20 different stocks, and 19 of them go insolvent. You're still gonna have a pretty good return, aren't you? Well, I don't have it set up, and you'll still make a fortune. That's the cool thing about finding the next Microsoft. You can be wrong 95% of the time and still make a fortune, as long as Microsoft is one of those 20 stocks. The challenge today is Microsofts keep getting bought out by the existing Microsoft. So these unicorn firms, Meta, Alphabet, Microsoft, they're buying these firms out before they become the next Microsoft. So it's kind of frustrating. I think it's going to get tougher and tougher for y'all to do that. But I was listening to Business Breakdown today. Very interesting firm. Never heard of it before. It's a firm called Wise, which is a great title, isn't it? Very expensive stock, no question about it. This is a $500 stock whose last earnings were 6 cents. I don't know how they got this PE ratio. It seems like it should be a few thousand, but really exciting, disruptive type of firm. I love all these type of firms. It's disrupting the industry that I hate, which is the payment industry. I think PayPal grossly overcharges what it does. My charity definitely thinks it grossly overcharges for what it does. This is a firm, when the average firm charges 6%, they charge 0.6%. and they make more money doing it than the firms that charge 6%. So that's kind of interesting. So I love firms like this. Could it become the next Microsoft? I don't know. It's already a $6 billion company, so it's already pretty good size pretty quickly there. I was looking at another company today that was kind of interesting. There was one that does 3D printing of body parts. So we're saying that's kind of interesting. That could kind of change the world. There's a firm that has a shot that if you take it, you lose weight really fast. And it works almost seamlessly. I mean, it's kind of, I don't know if y'all heard of these new shots. They're real expensive. But the great thing from the company standpoint is if you ever stop taking the shots, all the weight comes back. So which means what? You got a product people have to buy for the rest of their life. Anyway, want a $1,400 a month product that people have to buy the rest of their life. Sounds like a pretty sweet deal. So, are those companies out there? That's why Kathy Woods, looking at her art fund, what are those companies that are going to really take over the world? You need to find them early. So I like to find them when they have a little bit of revenue, but large losses. And then you jump in, and you don't have to pick one. You pick 20, 30, 40 of them. As long as one of them is Microsoft, you make a fortune. There's a good chance all 40 of them will go out of business though. So you might not make any at all. But that's what I'm looking. That's what I get excited about. And I'm not going to put, if you read my blog on this, I wouldn't put 100% of my portfolio on that and this kind of thing. But I might take 10% of my portfolio and start playing these type of little games and just let it ride. They go out of business. Hey, tough luck, but just let it ride. I wouldn't rebalance. You don't want to rebalance, right, with Microsoft. You want to just let it ride. And maybe when you have, $2 billion in Microsoft, maybe you'll sell a little bit then. You sell your original $1 so that you do well. All right, so pretty interesting stuff. You can see that what the geometric is telling you, and let me just show you the geometric. The geometric is telling us is if we made that 2 point something percent every month, all the way down. Bill Gates, I don't want to do that. Ending values can be exactly the same. That's what that geometric's telling. How did you get from $1 to your ending value? What was that return? It was a lot better than the arithmetic. Arithmetic much higher. So if we actually graph these two together, and it doesn't show up. I don't know why it doesn't show up. Let me just start all over from scratch. So you can kind of see it there, but it looks better like normal. Logarithmic. So there you get a better picture because you really get the story of Microsoft in one chart, don't you? You can see where Steve Jobs shows up. I could do the same graph with Apple. It's going to have a similar type of thing where it just really took off, although it's done really well here recently. So this is very, very telling. Still have a great return, but it's not a straight line all the way up. So you see what the geometric is telling you. If I did this with arithmetic, it wouldn't even make any sense. It'd just be two lines that were completely unrelated. All right. What we'll do, we might do this. Well, you got an exam on Thursday or Wednesday. So probably the Monday after the exam, we'll have a team case where you'll work this problem. You'll work this problem here from the last exam. I'll give you the exact last exam and you'll just calculate it. It's really pretty simple to do this, and we'll see how y'all do. The team 1 and 2 are neck to neck, first and second place, but other teams can catch up pretty quickly if you just prepare it in advance. So that's the key. And you have YouTube videos that show you how to do all of this. You can go back and review it. And you're gonna have to know it anyway for the finals. You might as well get ahead of the game. There's nothing more powerful for your memory than to be the one team member that knows it and shows everybody else. Your brain just absorbs it permanently. So we'll wait until after the exam on Wednesday, do it the Monday after that. All right. So that's returns. It gets a lot more complicated than this. We were talking last night. It gets really complicated when you have transactions, and then you have to decide. So we're talking about the Bloomberg portfolio. If suddenly 1,000 shares show up, Bloomberg's just going to assume you bought it at the end of the day at the closing price. But it makes a big difference what you assume. Do you assume you bought it at the end of the day? Do you assume you bought it at the average during the day? And then your benchmark the same way. When in the day did this happen? So there's several theories. You'd be amazed. There's books written on this. There's several different choices at USA. There was a team that did this at USA, and they didn't have a home. Their boss didn't want them anymore, so they called me and said, "Can we come and work in your area?" And said, "That's fine. That doesn't make sense because my team is building strategies, and you're going to now grade our strategies. So it's kind of like the fox in the hen house. But if the CEO doesn't care, I'll take the fox or the hen house, whichever one you are." And got into it. It's just amazing to me. We discovered at one point, one of our portfolio managers, not in my area, but another area, discovered how to game the calculations. So he would always beat his benchmark. And we essentially told him to cease and desist. Are we going to tell on him? So he ceased and desist. But he discovered how to do a certain trade. So that particular formula made him look like he was better. So we haven't figured this out perfectly. These numbers can be gamed. If you know what the assumption is underlying the calculation, you can then work against that assumption. What he discovered is on major updates for the S&P, if he did a certain type of transaction, he would essentially pick up 5-10 basis points without doing anything. He wasn't really beating the market. It's just the way the calculation works. So he figured that out. And it was kind of hilarious. So it's much more complicated than this. The CFA, their presentation standards are just a mess. They're just massive, and even they have to acknowledge it's not perfect. I memorized their presentation standards for the CFA exam. I had the longest mnemonic I've ever done. It was 64 letters long. I had this whole story written, and they never asked a single question on it. So I wish they just put a question, presentation standards with a question mark. I've been so ready for that question, but they never asked the question. And so fortunately, it was on all three exams. I mean, it was supposed to be all, so I didn't have to memorize a new mnemonic. I just kept memorizing for every exam, but they never asked a single question on that. But my guess is, I took that exam a long time ago. My guess is it's radically changed since then. So this is pretty important. This is how you decide whether you're doing a good job or not. But it's not perfect. It's got noise. It's got some inaccuracy in it. So just realize, we're doing the best we can. And that's what we learned last night talking to Michael was, this is what it's assuming. It may not be exactly what you're doing, so it may not be perfect, but at least gives you a pretty good idea of how you're doing. So it's probably going to be 95% correct. All right, then we get the risk. So there's 4 formulas you should know off the top of your head. So hopefully you remember these. 1, 2 of them, 3 of them you did in your stats class. So you should remember them. Anyone remember these formulas top of your head? If you're a finance major, you should know them off the top of your head. So I probably got at least 2 promotions because I knew these formulas to the top of my head. Any takers? So no takers. Standard deviation. Beta. Correlation. R squared is easy. R squared is just correlation squared. So once you have correlation, you have it down. All right. We've got a few minutes here. So let's see if I can get this into your permanent memory, because they're actually really simple formulas. Not only that, but they're almost the same formula 3 times. Did y'all know that? Almost exact same formula. So all 3 of them start with the exact same thing. Anybody remember what's the first thing you do? All right, so you need the average, okay? That's for standard deviation, you need that. For beta, you need that. Correlation, you need that. So step one, get the average. So let's get the average. We already did that, right? Average 2.3%. All right, Dante, you remember step two? You do what? All right, so average, the next thing you're gonna do is difference. We'll figure that out. Third thing you're gonna do, you're gonna multiply. Fourth thing you're gonna do, you're gonna take the average again, and then the fifth thing you're gonna do is something else. That fifth step where they're different, all right? But the first four steps, the first thing you do is figure out the average. Now, if you're doing beta in correlation R squared, you have to have two pieces of data. So we'll have to bring that in. Maybe I can do that here later. We'll try it. We'll have to show you. The next thing is the difference. So what is the difference going to be? What difference are we doing? This is like so foundational to finance. Huh? Well, how many differences do we have to do? Yeah, every single one of these, we got to take this minus this average, this minus the average, this minus the average, all the way down. What is standard deviation telling us? We're starting off with how far we can be from the mean. We're saying distance from the mean. Come on, Bill Gates. Ah, I don't even know what I hit there. Oh no, I've done that before. Where did I go into my language? What did I hit? Y'all see it? Where is it? I'm out, but it won't let me go back to the right language. I hit a button. I've done this before. I'm in like Russian or something. So I've done this before, and I don't think I can get out of it with just a new file either. Yeah. I hit some button and I don't know what it should be up here somewhere. Boy, irritating. I don't know what I would have done that either. And I got Zoom after me as well. I can't undo because it's not undoable. So
Okay, Google says to click file. Language.
file language. There's no
The bottom.
English. Yeah, it's not that. I think I switched keyboards. So, all right. So we'll do it with numbers. We can do it in numbers, and I'll just have to show you. So the first thing you're going to do is you're going to take each holding period return and subtract it from the average. R from the mean, or what's the other word we use in finance? It makes no sense at all, but we use it. What else do we call the mean? The mean, the average, the expected return. Exactly. Is it really the expected return? But that's so key for finance. So what are we saying with standard deviation, correlation, and beta and R squared? How far are you from the expected? That's our whole definition of risk. The further you can be from your expected value, the more risky it is. On standard deviation, we don't care if you're above or below. We just want to know the difference. All right. So we start with that. And put some space here so it, Bill Gates doesn't keep going down. Hopefully this will be fixed by next class. So you start with that. With correlation beta and R squared, you need two data sets, but you do both of them. You get the difference from their mean. Okay, so, but you start with the difference. Why is that so important? Because Boy, that's how we define risk in finance. The next thing you do is you multiply. For standard deviation, you multiply the number by itself. So you're essentially going to square that difference. So plus that times that. Okay. For correlation R squared and beta, what do? You multiply the difference of A times the difference of B. And we'll talk about that a little bit. But for standard deviation, you square the difference, which means what? What happened to this negative 14%? Two things. It became a positive number, so we didn't care that it was, we don't care if it's above or below. Second thing is it's an outlier, so it's going to be exaggerated in the numbers. A small number gets squared, it becomes a really small number. A big number gets squared and it becomes, you know, a pretty big number. So outliers, so there's two things there. We don't care if you're above or below, we only care about the difference. And outliers are very, very, very material to the amount, right? For beta and the others, you're going to do probably Microsoft versus the S&P 500. You're going to get Microsoft's difference from its mean, the S&P 500 each period from the S&P 500's mean, and then you're going to multiply those together. In that case, if they're both above their mean at the same time and both below their mean at the same time, when you multiply it, you always get a positive number. Y'all hear that? So if they're both above their mean at the same time, and they're both below their mean, if they're both above their mean at the same time, you'll get positive number and positive number. If they're both below their mean, you get negative number, negative. When you multiply, you get a positive number. All right. If one's above its mean, when the other one's below its mean, what are you going to get? You get negative numbers. So what correlation and beta are asking, which I think is really critical, is not how do they move together. That's the way you always hear it. It's not how they move together. It's how they move versus their means against each other. All right. They can both be positive at the same time, but you can still get a negative number. Because if one is up 0.5%, but its mean is 2%, it's still below its mean. So we're not asking if they're positive and negative at the same time. We're asking if they're above and below their mean at the same time. Okay, so that's a really critical thing. So what correlation and beta are asking is, hey, are they generally above or below their mean at the same time, or do they have some differences there? We'll have to do that once I get this fixed. But you still take the difference and you still multiply. The difference is with standard deviation, you can only get positive numbers. The correlation and beta, you can get negative numbers and positive numbers. Then what you're going to do is real simple. You just take the average of those differences. Real simple. Yeah, it doesn't recognize that name, so I can't. Ah, man, a lie. That's incredible. All right, so the average of those differences is, yeah. I did this one class before and somehow we figured it out. The average of those differences is 90903. And so how do we get the standard deviation? What's the last step we do? So what is that number there? Anybody know that number? It's got a name for it. It starts with a V, if that helps for you. That's the volatility there. So what is the standard deviation there? Even that doesn't work. So I can't, I'm completely out of the water. Yeah, I can't type anything. Boy, that's amazing. So the square root of the volatility is your standard deviation. So if I take the square root of that, I'll get standard deviation.
All right, press Alt Shift plus Shift.
Alt Shift plus Shift. Oh, that looked good. All right, good. All right, it's getting better. All right, so there's our average. So how do we get the standard deviation? We just take the square root of that, and then there's our standard deviation. We can check it with Bill Gates here. We Now he's messed up everything. Let's see if we can do this STDEV. I'm going to do the population because I want to get it exactly right. So how close did we get? Exact same number, right? Why did I do it by hand? And I recommend you do this with this spreadsheet. Just go in and calculate these numbers by hand so you know what the formula is doing, because there's so much theory in this formula. For standard deviation, difference from the mean, squared, outliers, all that stuff is in there. But isn't it simple? I mean, the first 4 steps, you're doing the same thing over and over again. Get the average, difference from the average of those differences, I mean, multiplied and the average of those multiplied differences, and then just take something else, right? Let's bring in, we're going back to July 86. Yeah, I'll bring in the S&P. The problem with this is, unfortunately for us, there's no download button there. So we'll just have to copy button. So when you're doing beta and correlation, you have to have 2 sets of data. Just make sure it lined up. Nope, it didn't line up. Oh, I went back to 486. Oh, sorry, so close. You do have to check because there are some problems with this data when you. I probably can't even do it like this, so it won't work. Yahoo Finances really mess things up. So even though you're bringing in monthly, it's possible your months won't match because of the way they do the maths, unfortunately. So really irritating. I don't know why they used to allow you to do this. Yeah, so it may not work. We may have to give up. I do have the numbers somewhere out there that I can show y'all, but we'll try that. But so essentially, what we have to do, and I'll show you another spreadsheet that I do already have set up. So essentially, what you have to do is calculate these 2. Let me show you the spreadsheet I use in my risk management class. So here, they're going to have to do an attribution. So here I got the contra fund, and I got their returns, and I got the S&P 500's returns. Okay, all the way through February of this year. And so what we can do, we've got enough time, we can get this done. So remember, for standard deviation, you take the average. Hopefully I don't save this file when I'm done. You take the average of these returns. There's the average, so the contra fund's done pretty well. You then take the difference from the average. For both of them, for the S&P, you have to do that for each month. And then for each month, you multiply those by themselves. And then you multiply them by each other. So you have the multiplication for standard deviation, you need the square. For correlation and beta, you need them multiplied by each other. And then you just take the average of those. And so your standard deviation is just that raised to the 0.5. You can double check since I'm doing it kind of fast just to make sure. Does it look pretty accurate? 417, 417, 426. So the only thing we're left with is beta and correlation. So I said the fifth step was something else. So we got the average, difference from the average, we multiply, we took the average of the multiply. Real easy. Y'all can get all four steps like that, real easy to remember. For standard deviation, we didn't take the square root of that volatility. This number, so these two numbers are volatility. That's the average of those square differences. It's called volatility. Anybody know what the average, the multiplied differences are for beta and correlation? Remember that number starts with a C and ultimately has a V in it. Covariance. So that's the covariance. Both beta and correlation, well, and R squared all use covariance. Anybody know the formula for correlation? When did y'all take stats? Been a while. Did you do like I did and say, we all got that class behind me, never need this again, and discovered it was my single most important class my entire undergraduate. All right, so correlation is covariance divided by the standard deviation of A times the standard deviation of B. That's correlation. We can check it, equal coral. So we do the contra fund, we do the S&P 500. How accurate was it? Pretty accurate, right? What's the highest correlation you can be? 1. What's the lowest it can be? -1s. All right. What about beta then? Beta is almost exactly the same formula as correlation with one little adjustment. Correlation uses the standard deviation of A and B, but beta only looks at the risk of the markets. What do you think beta is going to be? Covariance divided by what? Standard deviation of the market squared. You only use the market standard deviation because it's only market risk. So there's our beta. Oh, I did something wrong. That can't be right. I don't think. Everything goes wild. I think that's right, but that's certainly not their beta. Oh my word. Well, let's see what it is. I don't know what I did wrong. That doesn't make sense to me. Oh, I'm doing the wrong. Let's see. That looks right. That looks right. That's it. Well, I don't know what I'm doing wrong over here, but oh, I went. I think I really don't know what I did wrong, but all right, I'm just gonna copy this over. I think I badmouthed Bill Gates so much that he's like sabotaging me. So it's 0.88. I don't know why that's different what I just typed a second ago. 0.88. Now, how do I get this in Excel? Anybody know the formula in Excel? Good old slope, right? Except for you have to do the stock and then the market. The market has to be second. This be important when you do paper 3. So do contra fund, S&P. Does that look pretty close? .88. All right. So You should know these formulas just backwards and forwards. You shouldn't have to look them up because we use them so much. I've seen people use these statistics in really bad ways because they don't know the formulas. I had a friend of mine who was taking a graduate class, and two of the students were really struggling how to calculate the standard deviation of one number. It's like, how do you do that? What's the standard deviation of one number? Doesn't make a lot of sense, does it? And you can calculate it, equal STDEVP of that number. It's going to be 0. Because, I mean, it doesn't make any sense. So they obviously weren't understanding the whole purpose of it. You have to understand all of these numbers because you're taking a difference. Outliers can really influence it. You're taking an outlier and you're taking the average. One really big year, like, that's going to have a radical impact on your number. Then you have to ask the question, like if it's October 87, where you had, mark it down a bunch in one, if you're looking at daily data and you have to mark it down 23% in one day, then you got to decide, do we kick that out of our data because it really distorts the data because it's going to have a big impact. You kick that out, just assuming that was so strange, never happened again because we have these circuit breakers or whatever. Yeah, do you take 2008 out because of all of those strange weeks and days we had in 2008? Because outliers are so huge, has such a big impact on that. So let's see if anybody remembers what we just said here. What did y'all do in your stats class? Because my concern's always been with stats is that it's taught by the math department. And it's always been my position, stats should be taught to finance majors, should be taught by the finance department. Because it's a lot different, right? You're getting R squares of like 98, 97. It's like, you're not going to see that in finance. So it's the perfect class for a project. I mean, there's so much stuff you can do. It's really a great class. So I want to ask how they're doing it, but it should be your most exciting class because there's just so much you can do with that kind of stuff. All right, so standard deviation, also known as total risk. Can anybody tell me the formula off the top of your head? Nobody? Somebody can. I'm sure I'll pay $10,000 whoever can do it, unless I change my mind later. Take the average first, all right? All right, so you do x of I minus x bar. So you start with the difference first. So you square, yeah, multiply by itself, okay? So all your negative numbers disappear and your outliers are exaggerated, all right? So there's two of the numbers. What do you do next? Step 3. Step 3. Well, we've already multiplied. We multiply by itself. Take the average, right? All three of them, we're going to do that. Take the difference, multiply, except for correlation, multiplying two numbers, standard deviation, just multiplying number by itself. And then you take the average. So they're all exactly the same up until that point. This number is called what? That's a standard deviation. For standard deviation, this number is volatility. And so what is the standard deviation? Standard deviation is what? Square root of the volatility. Isn't that easy? And this is what you did in your stats class, right? And they show you, did they make you memorize the formula in your stats class? No, why didn't they make you memorize the formula? This is my opinion. If you don't know these formulas, it's like walking to the doctor's office with the pain in your side and the doctor takes out an anatomy book and see which side the appendix is on. What would you do next? I would run. A doctor that doesn't know basic anatomy as a finance major doesn't know these formulas because we use them all the time. So this is your anatomy. Maybe your stats professor has a bunch of marketing majors, but they better know this because they use it a lot. Maybe they have management majors, but they just don't know. All right. And then you do correlation. So correlation, what do we have? You start with the exact same thing here, right? No difference there. We're not going to square it. Instead, what are we going to do? Assume the market is Y. So we took the average. That's what X bar is. We took the difference from the average. What else do we need to do? So you got to multiply it by YI minus Y bar. I'm not doing the summation function, but there's a summation function in there. But that's why I got the average. And the next step is the exact same thing. You just divide by N. And you'll see how those formulas will practically identical. It's almost the exact same thing. And then we just got to do one last thing. Anybody remember the last step? So for standard deviation, we took the square root. For this, we're going to divide by something. No takers on that one. So standard deviation of X times standard deviation Y. And you're done. R squared equals correlation squared. Oh, I forgot to ask Dante. What is this? What is this right here? That's covariance. So this is volatility. This is covariance. R squared is correlation squared. Beta, also known as relative systematic risk. We'll talk about that more. Beta is just covariance divided by the standard deviation of the market squared. So they both use covariance. That's a nice thing. You get three formulas that all use covariance. You just got to know what you do at R squared. It's easy. You just square a correlation. Beta, you use the market standard deviation. You don't use the individual stocks. All right. So I don't know if this come up in the interview question, but I would ask this in the interview question. So, all right, I'll stop it there.